All right, we've got quite a few joined now, so I think we'll just get started while maybe a few others are just joining. So thank you to everyone for taking some time out today to join us at BDH Sterling for this webinar today. This webinar is about helping your clients make the right decision with overseas pensions. So going through the webinar today is my colleague Steph Mills. So Steph is a UK qualified advisor. She has a lot of experience both working in our UK office and now our office in Perth for the last 5 years. So she'll be going through the majority of the presentation today. Steph is qualified to give DB, defined benefit advice, and is very experienced in UK pension transfers. So she'll be giving a lot of her knowledge to you guys today. My name's Gemma. I'm one of the Australian qualified advisors with BDH Sterling. I've been in Australia now for about 14 years. I'll be just kicking off the webinar today and assisting with the Q&A at the end as well. So just to start, I just want to highlight our general information slide for you. So obviously anything we go through today isn't personal advice for you or your clients, and it is in line with UK and Australian legislation as of today's date. So if you just want to have a read through the general information warning for today. And this is the contents of the main areas that we're going to cover off in our webinar today. So Steph's going to be running through what types of pensions there are in the UK, the whys of why you and your clients would transfer, the main tax considerations, what options there are for any of your clients who are over 55 and also under 55, the main areas to be wary of and to look out for, what we actually do for fellow professionals and how our process at BDH Sterling works. And then we'll go through a Q&A session at the end. So please do feel free to pop in any questions as we go along, and then we'll address those at the end. So I will pass over to Steph now.
Thank you, Gemma, and hi, everyone. Perfect. So I'll just run through what the types of pensions are in the UK and why your clients could consider a transfer. There are two main types of pensions in the UK. They're very different schemes. The first is a defined contribution plan. This is also referred to as a money purchase plan, and these are very much like superannuation. They had fund values and they're market related, and normal names of these plans are personal pension or SIPs. And then on the other side of that, you have defined benefit plans. So these are plans that are also referred to as final salary schemes. And they're very different in that they don't hold fund values, but they do provide guaranteed income for life. And that's where the value of these plans really come in, and they're often referred to as the gold standard of UK pensions. They're based on how long your clients have been in the scheme employment and what their final or average salary is when they leave the scheme. You can request a value, a transfer value from this type of scheme. You get one free one every year. So the scheme does need to provide one of these every year, but you do need to request it. When you receive one of these values, you'll have typically 3 months from the date of the guaranteed period to do all of the advice, the analysis and research if you're looking at a transfer out of this type of scheme. So not very long to do all of that in that time frame. Most UK pensions can be transferred, but I'll go through the main ones that and highlight these here. So UK company pensions, so defined benefit plans such as Shell or Chevron, UK defined contribution pensions, so your SIPs and personal pensions. You might see names like Aegon or Aviva, Standard Life. Also local government pension schemes. So these are still defined benefit plans, but they will be with the local council. So if you've got clients that have worked in the local council, they may have one of these schemes. They're funded public sector schemes. CUROPS and QNAPs can also be transferred. There are some options that cannot be transferred. Often these are schemes that are limited to providing pension income only. The main ones being the UK state pension, it's not transferable. Also, the teacher's pension, NHS pension and the army pension in the UK. So these are unfunded government pension schemes and they're limited to income options from the scheme only. If you have any clients that have pensions in the pension protection fund, so this is where a defined benefit employer has become insolvent and the PPF takes on the income for life, you're not able to transfer away from that scheme either. Also, annuities are not transferable once they're in payment in the UK.
Thanks, Steph. So once the funds come over to Australia, they have to go into what's called a QROP superannuation fund. There's two options available. So clients can either set up their own self-managed super fund and then apply to HMRC to have the QROPS wrapper put onto that self-managed super fund to allow them to transfer into it. Or they can transfer into a retail fund. There's currently one available in Australia to do that. Once the funds are across in a QROPS account, they do have to report to HMRC for 10 years, and that's 10 full UK financial years after the final transfer. They also have to ensure that the benefits that they receive from having the funds here are broadly in line with the UK provisions. So that means they're over 55 before they're receiving any income. They can't invest in residential property, those kinds of rules. And then they have to comply with the member payment provision period. So this is the longer of 5 full UK financial years post the final transfer, or 10 UK financial years that you've been out of the UK for and in Australia. Otherwise, you are subject to this payment, which is 40 to 55% of the balance transferred. So obviously quite a substantial portion of the funds. You also need to be aware of the overseas transfers charge as well. So if the clients did decide to leave Australia and move back to the UK within 5 years of making the transfer, they'd have to pay a 25% fee back to HMRC for the balance that was brought over. So again, quite a significant charge there.
There are some reasons why it may be considered that a transfer out of the UK pension scheme is not suitable for clients. Certainly where your clients have defined benefit plans, the starting assumption from any UK advisor will be that a transfer out of this scheme is not suitable. This is because of the nature of the benefits that these schemes hold, being the guaranteed income for life, there's spousal benefits on there as well, and they index throughout retirement. The FCA, the regulator in the UK, will always expect that to be the starting position for this type of scheme. It may not be cost or tax effective to transfer away from a UK pension scheme either. Certainly where your clients have the DB scheme, they will take on costs that aren't apparent in their existing scheme if they look at transferring away from that type of plan. There may also be exit fees from schemes in the UK. This can cause a reduction on benefits in the future. And another consideration is that your clients may take on investment risk that isn't apparent in the scheme that exists as well. So this is also where they've got the guaranteed defined benefit plan. So they're bearing the investment risk for taking on the transfer. There are many options why considering a transfer can be beneficial for your clients. So we'll run through the main ones here for you. Investment control. So UK pensions are sterling denominated and you have limited options on the investments on many of the schemes that are defined contribution. So there can be some compelling reasons to take out that currency risk and invest in Australian denominated funds longer term. Your clients live in Australia, they want their investments and income to be in Australian dollars. Estate planning. So in the UK, there are some rules on death benefits. If your clients die before the age of 75 and after the age of 75, taxed after 75 and not taxed before. From a UK perspective, there are additional Australian taxes to consider if that's the case as well. But a new one just to bring to your attention is around inheritance tax. UK pensions have always been outside of the estate for UK inheritance tax, which means that if your clients die with UK pensions, previously this would never be brought into scope for IHT charges. This is changing from 2027, which means if your clients have unspent UK pensions, so really your defined contribution plans, they can come into the estate for IHT, depending on some other factors, how much allowances and other assets they have in the UK.
One of the other main reasons why you would consider transferring is just to take away that currency risk as well. This diagram here is just showing the last 5 years, and you can see how much the exchange rate has fluctuated from the GBP to AUD over that time. Steph and I have been quite busy in the last couple of weeks with the recent changes as well. A lot of clients are very happy with what's happened the last couple of weeks. But for your clients, if you're trying to plan their long-term retirement, trying to see if they can meet their goals for the rest of their retirement, having that bit more of a guarantee to know what the funds are worth without having to take into consideration they could go down or up with the exchange rate is another reason why it's good to transfer the funds over. The other reasons are the tax treatment once the funds are here. So as I'm sure you all know, once you are in superannuation and move to account-based pension, you're able to receive tax-free income in retirement for the rest of your life. So you've got that tax-free income, whereas in the UK, there could still be tax to pay. The only tax to consider is that any growth in the fund from leaving the UK, moving into Australia before transferring is taxed when it is moved over here. So if that's moved to super, it's taxed at 15%, or if the funds are moved over to your personal name, then it's in your marginal tax rate. It also gives clients the opportunity to consolidate all of their pensions, and again, for you guys looking after your clients, easier to manage their funds ongoing. So if they were to open a Cureop self-managed super fund, they can roll their other Australian supers into that Cureops fund. So then you can have everything in one place to manage ongoing. And after the Cureops reporting period, there's the opportunity to roll out of those Cureops funds into the other existing Australian super funds that you do manage. Just to note there as well, we've said you can't access the funds for either the 5 or the 10-year rule. As long as you meet the Australian conditions of release, you can still access those funds to commence pensions as you would with your other super funds. So as long as you meet the Australian rules for the account-based pension, you can access the funds before the 5 and 10-year rule. You just can't roll out of the Cureops into a non-Cureops super fund in that time.
Thanks, Gemma. So if your clients do leave their funds in the UK, just some pointers to highlight in terms of the tax. So the UK and Australia is inside of a double taxation agreement. If your clients are receiving income from a UK pension, then they will be taxed in Australia at their marginal rates of tax. Now, UK pensions will generally pay income to clients taxed in the UK as well. So your clients may get taxed in both countries, but they will be able to go through a process of reclaiming the tax in the UK. It's only due in Australia because they live in Australia. Your clients, or you may have all seen that some UK plans will offer the option to take a lump sum. Normally, this is 25% of the value of the plan, and defined benefit plans will also allow you to give up some of the income for a lump sum as well. If your clients were living in the UK, resident there, then this would be a tax-free payment to them. But as residents in Australia, it does usually contain a tax, which is the growth normally since you've arrived in Australia, and this can be at marginal rates of tax. So just something to be mindful of if your clients are looking at drawing the lump sums directly from the UK pension schemes. Lump sums are potentially taxable in both countries, but it does depend on the type of payment. Perfect. So in terms of how we would look to typically bring funds into Australia through a transfer strategy, your clients' funds will be split into 2 components. So the first one is the growth of the fund. As Gemma mentioned before, this is normally from the date of arrival in Australia until the date of transfer. So this is what we call the growth or the applicable fund earnings. And generally this is taxed from super at a concessional rate of 15% if it's transferred in a specific way, which we'll highlight later. So you have the growth of the fund which comes over. This does not count towards any non-concessional caps, so it's outside of the caps. With the balance that your clients have accrued previous to their date of arrival, so everything before they came over, you would look to bring these over using the non-concessional contribution cap. So normally we'll use a mixture of 120,000 and 360,000 using the bring forward arrangement to bring over those larger balances over multiple years. There is another pointer here on the UK side of things, where your clients have larger funds. There is a new limit in the UK, which has replaced the old lifetime allowance, which is called the overseas transfer allowance. So your clients will have around £1 million that they're able to bring over from the UK without any tax consequences on the UK side. Your clients may also have what's called a transitional protection. So normal ones that you might see are fixed protection 16. It just gives your clients that little bit more of a buffer in terms of how much they can bring over in that tax-free period.
Okay, so now we're going to have a look at what the transfer options are for the clients that you have that are age over 55. So if they're over 55, it means that they now meet the condition to be able to transfer to a CureOps fund. And we just have to work within those limits that Steph's just mentioned. So the growth and then any non-concessional contribution limits they've got available to them here. Or they could decide, or the advice could be to leave that pension in the UK.
Thanks, Gemma. So we'll look at a case study here. We've got Janet, who is 58. And she's got 2 UK pensions, total value is $740,000. And she's looking to bring the funds into Australia and also access some funds, if she can, to pay down debt on the home. She's over 55, which is currently the magic age for UK pensions, where you can either draw benefits or look at transferring them through a CureOps. So we'll go through how we can look at a consolidation and commence a strategy to withdraw some of the funds and bring the remainder into super. So in this flow chart, you can see that the existing 2 pensions come into a new pension in the UK. The reason for this is that often the schemes that your clients will already be in are not able to carry out these strategies directly from the scheme unless they've got smaller balances. Where they have larger balances and the components need to be broken up, it does often need to go into a different product that can do that type of strategy. I'll just talk you through how that would work. So with this new pension in the UK, Janet has bought some currency. So she's got 740,000 there from her UK pensions. The first component that comes into the Australian super, the CureOps super, is the applicable fund earnings. So that's all of the growth that we talked about before since Janet has been in Australia. So quite a considerable amount here. She's been here a long time. $500,000 is the amount of growth that Janet has. So this would transfer into a new pension from the existing one, and we'll call this SIPB. And then this pension transfers into the CureOps as the first payment. And by doing it this way, it allows that concessional rate of tax to be paid from super when that SIPB closes with a nil balance, which it would do after this transaction. So we've removed $500,000 from the UK and we've got $240,000 left. So Janet wants to look at paying down some debt. She's able to access 25% of the balance as a lump sum, which is paid directly into her personal bank account. So in this example, it's $60,000 that would be paid to her. And at this point in time, that lump sum is tax-free because the tax has been contained in that growth transfer, the applicable fund earnings. So if these happen really closely together, which they would, then the lump sum is generally tax-free for Janet. The reason that it's limited to 25% of the balance after the growth is that if you looked at taking 25% on the 740,000, you would actually contain that growth, the applicable fund earnings, in the lump sum, and then that would be due at marginal rates of tax to Janet, which is often more than 15% that the super can provide. So in this example, we've paid the lump sum, we've got 180,000 left. So we'd look to bring that over using Janet's non-concessional contribution caps. And in this example, we're using the bring forward arrangement to do that. And then we've got no funds left in the UK. Everything's come out of the UK pension. We've got $680,000 in the super and 60,000 into Janet's bank account. Of that 680,000, there will be tax due on the 500,000, which is the growth transfer, which comes over and is paid directly from super. So in this example, the non-concessional contributions that have been used is 180. The 500,000 hasn't used any of those non-concessional contribution limits. All right, so we'll look at some options that we have for clients that are under the age of 55. So they're not quite old enough to look at the transfer option into CureOps. There's a couple of options that would be considered. So either retain things as they are, keep things in their current pension scheme, or look to bring them out of that pension scheme and consolidate into another UK plan, one that can do Australian dollars and get ready for the transfer strategy at a later date. So some options that will be available if your clients look to consolidate in the UK before they're 55. So if they look to come out of where they are and into a different pension, they could take the currency risk out and buy dollars. They will be able to buy Australian denominated investments. So there's some short-term and longer-term investment options depending on timelines and risk appetite. And there'll be more involvement on the investment options available, which sometimes isn't apparent or easy in some of the existing schemes that they'll have. So in this case study, we have John, and he is 53. He's got two company pension schemes that are valued at $350,000, and he'd like to bring them into Australia. So we'll look at the process of how he can do that, bearing in mind that he's not quite old enough to do it at the moment. So in this instant, we would transfer the existing plan into a new pension in the UK. So at age 53, we would do that. And then you'd have the option to buy the currency. And then when that's bought, you'd have currency options for investments, or you can retain the funds in sterling. And then when John is 55, he'll be able to start the process of the CureOps advice. So being able to set up either the self-managed super fund or the retail scheme to start bringing the funds into Australia. Now, based on the balance that he has, it's likely that he would be able to bring this over in one transaction if he's got full non-concessionals available, using that bring forward arrangement, and bearing in mind that he's likely got an element of growth there as well, which is outside of the non-concessional cap.
So there's a few things to be wary of when you're speaking to your clients about this, and things that they might mention that might be a bit of a red flag. If they've had any offshore advisors, they potentially could be unlicensed in Australia or in the UK. If they have any investment bonds within a CureOps or a SIPP product, and we'll go into more detail in the next slide about that one. There's obviously constant tax changes in the UK and Australia, and we need to keep on top of both of those sets of rules to make sure that any plans, any strategies that we have in place remain compliant on both sides. So to get specialist advice is essential in that area to make sure that we're not breaching any caps or not breaching any rules either side, because obviously the penalties are quite high, up to 55% of the fund being lost. And also to ensure that the UK pension is transferable, as Steph mentioned earlier, there's only certain funds can come across and certain can't. So this is just going into a client, Mrs. Smith, who does have an underlying bond within their UK pension. And just something to mention is that quite often clients don't realise that they have bonds within their UK pension. So it's definitely something that just needs to be looked into and researched a little bit more before making any recommendations. So if Mrs. Smith had a bond in her pension of £200,000, she would have paid an initial commission to the advisor to set that up of 10%, so it's £20,000 already gone. She'll also be paying an ongoing fee of 1%, as well as additional admin, platform, other investment and advisor fees. So if she then wanted to transfer the funds out of the pension and over to Australia as part of the UK pension transfer, after 5 years of holding the product, she'd then have to pay another exit penalty of the remaining 5% of the redemption bond. So that's a another £10,000. Obviously quite a costly exercise if there is a bond involved. So we'll just now talk you through the BDH Sterling B2B service that we offer, and part of what Steph and I do here. I'll let you go first, Steph.
Perfect. Thanks, Gemma. So one of the main benefits of working with us is that we don't outsource anything. So we have a team in the UK that we work with a lot on our UK pension transfer work. So our head office is in the UK as well as offices here in Australia. And we really lean on them to talk to the providers a lot to push through research and chase transfers and be on the ground being able to do that. Also, our administration, power planning, and all of our defined benefit work is in-house. We don't outsource anything. You can also benefit from working with UK licensed advisors that are based in Australia. So we're happy to talk to you and your clients on the ground here, whether that's face-to-face or via Teams. And we also remove the compliance risk. So a lot of your firms will not be able to do the CUROPS advice, for example. So this is where Gemma often comes into play in our B2B process, where once our UK advice is prepared, Gemma will look at preparing limited advice under our Australian license for you, where she's looking at which CUROPS option is best for your clients. So we can do that part of the process for you as well. We're also happy to take technical queries. So if you ever come up against something that is a little bit out of sorts because it's UK based, then we're happy to help you go through the process of figuring out what it is that is.
Yep, so we also, as part of the process, you know, we understand that the client is still yours. So we do very much involve you throughout the process. So we copy you into all email correspondence with the clients to keep you involved. We'll invite you to all meetings that we have with them, because at the end of the day, they are still your client. As Steph said, she would do the UK side of things. And then if you want us to set up the CUROPS account, it'd be passed to myself or one of the other Australian advisors to give the CUROPS advice. We get that set up, we get the funds across, and then the client is basically handed back to you for the ongoing investment and ongoing management of those funds. It really is sort of a value add for you and your current practice. So if it's something that before clients might have asked you about and you don't feel that you can help them in that area, you know, that can be referred to us, and it can be that another level of service that you've given them, maybe making the clients a little bit more sticky, that you've helped to bring these funds over, which can take a few years depending on the strategy. So it's really keeping those clients for the long term and moving all of their pension funds across. At the end of it, you're going to have increased the funds that you're managing. So you will you'll benefit from that over the long term, again helping your clients to plan for their retirement with all their funds being here. And you can then bring in the consolidation of the superannuation once it's here on the Australian side as well, whether that's moving existing funds into the CUROPS SMSF, or once they're out of reporting periods, moving the CUROPS funds out to normal retail superannuation funds. So this next slide here just sort of details the process of how we work and how we would go through from start to finish with you. So as you guys would have done, we want to get to know your clients. So that involves us having an initial meeting with them to find out about their needs, their goals, their current situation. It's, you know, us completing our compliance documents as well in terms of the fact finds, risk profiling if appropriate. Steph would then initiate doing the pension research. So if the clients have got 2-3 funds in the UK, we're going to write to each of those schemes and get all of the full details from them. So we've got a clear picture of what they've actually got in the UK. And then Steph or another UK qualified advisor will write the pension transfer analysis report. So that's a UK compliant advice document that we'll provide to the clients to state their current situation, both in Australia and from the UK pension funds, and then giving our recommendation as to the transfer strategy and how that will work over the long term. If the client's under age 55, it would then include any advice of how we're going to consolidate in the UK, how we're going to invest and hold those funds until they can transfer. And if they're over 55, then that's when they would be passed to someone like myself to get the CUROPS advice done, get the CUROPS account set up and get that transfer initiated to get the funds over. And as we said, keeping you in the process the whole time. It's still your client at the end of the day. And once the process is done, it's sort of fully handed back over to yourself.
Yeah, and just to add to that, where your clients do have the defined benefit schemes, we do ask additional questions. So the regulator again does expect us to really deep dive, sorry, into this area of advice, and we ask additional questions. And it's quite rigorous, the advice process for a defined benefit plan. In any of our advice as well, we'll always ask you what you're looking to invest the client in long term in Australia. This is because as part of the two advisor model in the UK, we do need to understand long term where those clients are going to be invested, just so that we can make sure that it's QROPS compliant and that the investments are in line with their attitude to risk. But we'll always talk to you about how that will be apparent throughout the process, and we can always talk about that as we go through as well.
Okay, thanks, Steph. That's the majority of our sort of presentation for you guys today. And we're happy to take any questions you may have. So I think there's one come through. So we've got a question here. Are pension payments within the 5-year, 10-year period subject to UK tax?
If they're payable from the QROPS, from the super, then no, they wouldn't be. So the tax would be on the transfer only, which is the growth. Once your funds are here in super, your client meets condition of release, as Gemma mentioned before, tax-free income in retirement.
Sorry, I'm just pulling up the next questions. Okay, this is a good question. So how different would the process be for someone with a balance of, for example, £2 million?
Yeah, so good question. So I mentioned before that there are some limits in the UK on how you can extract funds without any tax from the UK. But there are a couple of other allowances in the UK as well. One of those is a lump sum allowance. And that is a quarter of the overseas transfer allowance. So it's just over £250,000. There'll be a way in our strategies that we can incorporate that so that we're releasing lump sums and non-concessionals to bring that over. And then ultimately there might be some options with the balance on how that can be handled as well from a UK perspective. So whilst it is harder to be completely tax-free from the UK side when balances are that high, they're always looked at case by case with the goal of how can we bring as much over as possible or extract that in the most tax efficient way for your clients.
Okay. The next one is there a maximum age for transferring into the QROPS fund?
Yes. So with QROPS, the transfer from the UK is deemed as a contribution. So similar to super rules that you will all know is that you can make contributions to age 75. So it's the same with transfers. And then you get that grace period after the month of the birthday. So you get about 28 days after age 75. So if you do have clients that are coming up to that age, best to look at it early. We have had some very close calls with clients that are 75. But yeah, that would be the last opportunity to transfer into QROPS.
Are all defined benefit schemes transferable? What else needs to be considered?
The defined benefit schemes that are not transferable are your unfunded government pension schemes. So these are your teachers' pension schemes, civil service, National Health Service, those types of schemes from the UK. If you've got clients with those, they're not able to transfer. They were inside of the transfer ban, which happened quite a few years ago. With the other schemes, so this is your local government pension schemes and also defined benefit schemes with private employers, then yes, often transfers are options. Now, the schemes have a legislative right to only offer transfer values and the right to transfer up to 1 year before the client's normal retirement age. So the normal retirement age of a defined benefit scheme is scheme specific. So you would need to check that with the scheme. It's often 60 or 65. And what that means is 1 year before that, the client is able to transfer legally. And then after that age, it's dependent on the scheme. So you'll see a real mix of schemes that will allow it past that age and those that don't. For example, local government pension schemes often are quite strict on not allowing transfers after that time, but some of the private schemes are more open to allowing it after the scheme normal retirement age. It depends on the scheme.
We've got one here, which I might answer, give you a break. Is the 15% transfer tax payable in the UK or Australia? How is it collected practically? So if we are able to do the transfer as we did in the example, and all of the tax is within super, if it goes into the retail fund, when the funds come across from the UK, the retail fund actually takes the 15% tax upfront, and they give you the net amount into your actual account. So you never see the full gross amount go in, you just get the net amount, and the retail fund will then pay that to HMRC. So that's the way that's transferred. Or if it goes into the self-managed super fund, you can retain that 15% tax in the fund until your self-managed super fund completes their tax return, at which time you will then send the 15% tax, sorry, to the ATO, not HMRC, to the ATO at that point from your super fund. So what we generally do as a strategy, if you're going into the self-managed super fund, especially if it was a case like the example where there's $500,000 of growth, is we will calculate what the AFE is, we'll put it into a high interest cash account so that you can keep those funds and the interest that you earn for that year before you then go ahead and pay the tax. So it's a bit of a benefit of the self-managed super fund there, because you get to retain the tax for a bit longer. I think that might be all of the questions. Has anyone else got a last minute one before we wrap up? Nope, nothing else coming through. Well, thank you for joining today. We hope that you all got something out of it. A recording of this session will be sent to you within the next 48 hours if you do want to listen to Steph and I talking again. You also will receive a feedback survey, and we'll just really appreciate it if you can fill that in. I think it's a super quick one, and send it back just to help us to improve these sessions in the future. If you've got any specific questions, obviously about your own clients or anything else that comes up after this, please do get in contact with us. Some of you might already have Steph's details, you're working with her already, or through to our general inquiries at bdhsterling.com, and the relevant person will get back to you. So thanks again for taking some time out today to join us, and hopefully we'll see you guys soon.
Thanks, everyone.